here is something that should not be happening. The Eurozone just posted stronger than expected PMI data, the kind of numbers that typically send the euro surging against rival currencies. And yet, on Saturday the 25th of July, 2026, the euro is falling. Not rising, not holding steady, but actually declining. If you trade currencies or follow the foreign exchange market, this is precisely the kind of contradiction that demands a clear explanation. So today we are going to break down exactly what is going on, why the data is telling one story and the market is telling another, and what it means for anyone with exposure to the euro in the days and weeks ahead. The gap between positive economic data and a weakening currency is telling us something critically important about how FX markets work in 2026, and by the end of this video, you will understand exactly what that is and how to use it. Before we get into why the euro is falling, let us make sure we understand what a PMI actually is, because it is one of the most closely watched economic indicators in foreign exchange trading. PMI stands for Purchasing Managers' Index. It surveys senior managers at private sector companies, asking whether business conditions are improving or deteriorating compared with the previous month. A reading above 50 signals expansion, meaning the economy is growing. A reading below 50 signals contraction. The Eurozone PMI data released on Friday the 24th of July, 2026 came in strong and above market expectations, clearly signaling that the bloc's private sector is in solid expansion territory. In normal circumstances, that reading alone would have been enough to push the euro higher against the US dollar and other major pairs. Traders typically respond to strong PMI figures by buying the currency of that economy, expecting stronger growth to keep central bank interest rates elevated for longer. But today, that logic has broken down completely, and understanding why is the key to this entire story. So what has changed recently, and why is the market effectively ignoring what looks like genuinely positive economic data? The answer lies in the broader narrative surrounding the European Central Bank and its policy direction. Even before Friday's PMI data was published, the euro had already been under pressure. Just days earlier, on the 22nd of July, 2026, the euro was holding near 5-week highs against the Japanese yen, partly because the Bank of Japan had made hawkish comments that briefly gave the yen a boost. But that period of euro strength did not last. The market has grown increasingly cautious about the ECB's policy path going forward. While the U.S. Federal Reserve continues to keep interest rates at elevated levels, traders are now pricing in a scenario where the ECB may need to begin cutting rates sooner than previously expected in order to sustain economic growth. That interest rate differential narrative is the dominant force weighing on the euro right now, even as the economic data continues to come in positively. Strong PMIs capture the current state of the economy. Currency markets, however, trade on expectations of where rates will be in the future, and that forward-looking logic is winning the argument today. The immediate impact of this contradiction is being felt across trading desks and retail investor portfolios right now, on the 25th of July, 2026. Euro to US dollar traders who positioned themselves long on the euro ahead of the PMI release, fully expecting a rally on the back of strong economic data, have been caught on the wrong side of this move. The euro's decline against the US dollar underscores a growing theme in FX markets this year. Economic data alone is no longer sufficient to drive a currency sustainably higher if the rate outlook tells a different story. What matters far more in today's environment is the relative policy outlook between central banks. The US dollar remains firm, supported by a Federal Reserve that has kept borrowing costs higher for longer than the majority of market participants anticipated at the start of 2026. Meanwhile, the euro finds itself caught in a difficult position, squeezed between solid economic activity on one hand and growing market expectations of European Central Bank rate cuts on the other. That squeeze is playing out in real time today, and it has caught a significant number of traders off guard. Let us now take a closer look at one of the most instructive cross-currency pairs right now, euro to Japanese yen. On Friday the 24th of July, 2026, this pair was consolidating near the 187.00 level, with market analysts closely watching to see whether buyers could push the pair up towards the 188.00 resistance zone. Bulls are targeting that level, but price momentum has been uneven and unconvincing. The Bank of Japan's recent hawkish commentary has kept the yen supported to some degree, which means any underlying euro weakness is being amplified in this particular pair. Just a few sessions ago, on the 22nd of July, 2026, the euro was actually trading near 5-week highs against the yen. Since then, the shift in sentiment has been notable. For anyone tracking euro to Japanese yen, the 187.00 area is now a key decision point for the market. A clean and sustained break below that level would signal that the euro is losing ground on multiple fronts simultaneously, which would represent a meaningful deterioration in the single currency's broader technical outlook and would likely trigger further selling. It is also worth stepping back and looking at what else is happening across financial markets today, because currencies never move in complete isolation from other assets. Gold is gaining ground on the 25th of July, 2026 despite a firm US dollar, which is itself an unusual development. Normally, a strong dollar pushes gold lower because it makes the commodity more expensive for buyers holding other currencies. The fact that gold is rising alongside a firm dollar suggests that safe haven demand is building for reasons that go beyond simple risk-off sentiment, and that is a signal worth paying attention to. Bitcoin, meanwhile, is showing early signs of accumulation according to on-chain data from Glassnode, with analysts suggesting the crypto market could find its cycle bottom during the third quarter of 2026. Separately, the World Foundation raised over $52 million in a token sale this week, marking the third anniversary of the World Network. These cross-asset signals together paint a picture of investors who are cautious but actively repositioning capital. The euro's weakness fits neatly into that broader pattern. Risk-adjusted returns available in other assets and other currencies are currently looking more attractive than holding the single currency at prevailing levels. So where does the euro go from here? Based on the evidence available today, the near-term outlook for the single currency is cautious at best. Strong PMI data has clearly failed to reverse the existing downtrend, and that tells us something important. The market is firmly and decisively focused on the ECB's likely policy trajectory rather than on today's economic readings. If the European Central Bank signals any inclination towards cutting rates at its next scheduled meeting, the euro could face a further round of meaningful selling pressure. On the other hand, if the run of strong PMI readings continues and inflation data across the Eurozone remains stubborn, the case for imminent ECB rate cuts weakens significantly, and that shift in expectation could provide genuine relief for the euro in the weeks ahead. The euro to Japanese yen pair's battle around the 187.00 level will be a critical indicator to watch in the next few trading sessions. A sustained and convincing move above 188.00 would suggest that underlying euro resilience is beginning to return. Until that evidence arrives, the path of least resistance for the euro remains to the downside. Here is your clear takeaway from today. The euro falling despite strong Eurozone PMI data is not a paradox. It is a sharp reminder that in currency markets, what matters most is not where the economy stands today, but where traders believe interest rates are going tomorrow. The ECB's policy outlook is the single biggest weight pressing down on the euro right now, and no amount of above-forecast PMI data will change that dynamic until the narrative around central bank policy begins to shift in a meaningful way. Watch the euro to Japanese yen pair around the 187.00 level carefully this weekend. Track the next ECB communication for any change in tone or emphasis regarding rate cuts. Keep a close eye on whether gold's safe haven gains continue to build, as that would reinforce the cautious mood that is currently running through global financial markets. The interaction between strong economic data and a weakening euro is one of the defining FX stories of July 2026, and the resolution of that tension will shape price action across multiple currency pairs in the sessions to come. If you found this analysis valuable, please subscribe to the channel and hit the notification bell so you never miss our daily coverage of foreign exchange markets, global economics, and commodity price action.